Live. Okay, so you're live 22. I've got about 10-second delay. So I'm just going to start talking now. Hello, everyone. Welcome to As Good as Gold. We're back again. We had a bit of a break for the algo series that we did, but now we're back on. We're talking about gold. We're talking about all things macro at the moment, and we're going to focus very much on what's going on there. So hopefully everyone can hear me okay, loud and clear. Hopefully this is all going very nicely. So thank you for joining me. If you do find yourself liking the video, hit the like button. It'd be great to have, and it'd be great to push the channel. So let's crack on. I'm going to focus straight away on the gold market. Let me just check this 2 seconds. Okay, beautiful. Okay, so it's all looking good so far. Okay, so we've got the week for the daily gold chart coming up straight away. You can see that we've broken the downtrend recently. We're just back trying to look to sort of pushing back into this resistance level of 1776. It looks like the market's quite happy to sort of plod sideways at the moment. What we can see is this consolidation after the trend break. A bit of a move lower in real rates, and that's something that we're going to be content with going forward. So at the moment, it's pretty difficult when you're looking at a daily chart to make up any kind of really clear picture because markets are moving sideways. We've had 5 bars now of markets doing very little. It really doesn't know what it wants to do. So there's really no conviction from the bulls to push this high. There's no conviction from the bears at this stage to push this lower. We can see the 9-day RSI perfectly mid-range, pretty much telling you everything you need to know about this nuanced market at the moment. And then you've got the average true range. If you're looking at the volatility there, or the ranges that we've been seeing, is obviously collapsing as well. Does that set us up for a big move coming through? I think that's obviously the big situation that we're watching. I'm going to sort of go through the various factors that we're seeing in the gold market in the short term. But you know, I think if we're taking a tactical view, then I think, you need to have a look at what's happening on Friday. We've seen a pretty good ADP payrolls number coming out yesterday. We've seen the jobs number within the ISM manufacturing and also within the services coming out, showing some good expansion in the labour market. So, yeah, we've got payrolls coming out tomorrow night at 11 o'clock. And, what do we expect? The market's looking for 500,000 is the consensus medium number there. The high number for estimates is 750,000. And then there's one shop, where is that? Bank PK, who are looking for 0 jobs. The question is what does a bad number look like and what does it do to the market? I think that's going to be the big risk there. So the actual standard deviation of that consensus is 117,000. So I think if we were to see somewhere probably, around sort of or below 250,000, then the market would see that as a bad number. Is it really going to change the situation with the dollar, with real rates, and also the gold market and as the second derivative? I'm not so sure that's going to be the case. I think the risks are skewed for stronger dollar and then lower gold prices. That's how I tactically think about payrolls if we're thinking about this as an event risk tomorrow night. And why do I say that? Well, I think given what we're seeing with energy prices, and obviously we can focus on what's happening in natural gas. Everyone's been talking about it. We've seen this explosive move up, bearish outside day reversal though. So if this kicks lower, actually that could be quite good for. That could reduce inflation expectations, and that could have an impact on real rates as well. So that's something we are watching pretty closely there. If there's follow-through selling in natural gas, European and UK natural gas, that could have an impact on the bond market itself. So that's one thing we are watching. If this kicks lower, then I think short positions in natural gas probably look quite good in the short term. We'll have a look at what happens in crude because we saw an outside day reversal in UK or Brent there, and also similar situation coming through in WTI crude, and we're seeing sellers coming through. So after such a powerful trend, there's a change of ownership that will have implications for the gold market. You might not believe it, but because of the impact that these raw materials, so these energy inputs have into the bond market, that then has an impact on what we're seeing in the gold market itself. So what I want to have a look at is we can see some good buying coming through. You can see these long candles, these long wicks playing through. There's clearly good support in the short term, into 1749. So if that rolls over a little bit and chews through these bids, those people are going to be offside. I think we then look to trade down into this 1733 range. A break of 1777, I'll be looking to try and take that long into 1800. I think that's really where we're looking. So we're in this kind of no man's land. It's very difficult to have conviction when the market's doing this. 4 days of sideways move, falling ranges, range contraction, and the mid range. This is a range traders market. I say this every time I've been doing this. It really is a range traders market. You know, if there's other markets which are trending, there's very, very high volatility in natural gas, and some of those markets is attracting a lot of attention. Be careful if you are playing those markets, because the implied volatility in natural gas is about 115% for 25 delta puts and calls. So it's a very, very dysfunctional market. You could get a 20% move or 10% move, in certainly the US one, off the bat. But that's having taken out some of the impetus to trade gold. And that's a similar situation in crypto as well. I mean, if you have a look at the moves you've seen in Bitcoin, there's a lot more sort of trending, explosive, impulsive moves that are playing through in Bitcoin, to an extent in Ethereum and some of the other altcoins as well. So there's a lot of trader money going back into those markets. Let's go into my models here for just to show you the influence the bond market's having on gold prices at the moment. Let's focus on the top pane. You can see gold, which is as close to as gold as possible. It's orange, but let's consider it to be gold for now. And you can see that the gold price has had a bit of a bounce of late. But you can see that the reaction here is that real rates, this is inflation adjusted treasuries, very, very important. I talk about this every week, and that is because if gold has no yield, think about gold having no yield. And if the real or inflation-adjusted returns that you're getting in the bond market are becoming less negative, you can see at this stage they were trading negative 120 basis points. They pushed up to negative 84. So that's a big reduction. And that has been very positive for the US dollar. You can see that the dollar has worked, concurrently. There's been a good coefficient between the two there. And you can see that, the gold prices haven't really done much, but you can see the gold price down a little bit in that time. So that relationship has re-exerted itself in the very, very short term. What I might do actually, just to show you this a bit better, is I'm going to flip gold upside down so you can see the relationship a little bit better. Okay, so there you go. So you can see the correlation broke down here, but it does seem to have re-established itself here. So when real rates, real treasury yields are going higher, we can see the gold price under a little bit of pressure there. And we also can see that as the real rates are going up and relative to European bonds and other markets as well, that the US dollar is rallying as well. Now that is weighing on the gold price a little bit as well. So we've got to take a view on what's happening in the US dollar here, because if we're trading gold and we're trading it in US dollar terms, then of course if gold's not doing a lot and the dollar is rallying, then you are going to see gold under a bit of pressure. Now, what I can see here from this chart on the daily chart is that we've got this kind of flag pattern in play. We've broken through this kind of downtrend, this row of three negative candles, and we're making a stage up. What I want to see is the dollar really breaking through 94.50. If we do see a break of 94.50, which is probably going to be driven by higher real rates, real yields. Why is that? It's probably going to be because we've seen better non-farm payrolls numbers on Friday. Then my view is that we're going to be so I'm going to be looking to sell gold on the back of that. I think I think then gold looks to trade down into this 1730 region on the back of that. So that dollar is really key for me. Real rates are absolutely key for me. So I want to have a look at this dollar position. If we can, a bit of selling playing through here, but if this kicks up into European trade, and we can get a break of this number 94.50, which will be driven predominantly by what we're seeing in euro dollar. Euro dollar has a 57% weighting on the dollar index there. But you can see a big move down into the 5-day exponential moving average. The sellers are here. It's just holding these lows at the moment. You can see a bit of negative, a bit of positive divergence playing through. That needs to be paying attention to. You can see here the RSI, which probably couldn't get much lower, to be fair, has seen a higher low, and you can see there a lower low playing through in terms of that. So that may mean that we're going to get a bit of reversal. So definitely something to need to watch. But at the moment, this is a good trend lower. It's holding the exponential moving average. It's finding sellers into that. If this kicks lower, you're going to see the dollar index moving higher. And what does that mean for gold? Where it means you're probably going to see real rates moving up, and that means gold prices are going to be going down there. I would be looking to stop. I would be looking to go short gold in that dynamic with a stop loss. Where would I put a stop loss? Let's go to my Okay, so this what I've got here is my implied volatility chart. It's very difficult to understand for people who have never seen this before, so I'm not going to spend too long looking at this. Is overnight implied volatility, and this is weekly. So this is how I understand what the market's expecting over a 5-day period. They're expecting, with a 68.2% level of confidence, that gold is going to trade 1788, 1730. And this is a model that I've made based on 1 week implied volatility in the gold market. This is what the market's expecting in movement. And I've just got that number and I've projected it on the gold price to understand where they see the gold price is being contained into. So they're the levels I'm looking at. On a daily basis, though, the market's expecting a move about $18. So I'd be using that as a stop loss. There you can see there that the market on a daily basis contained within these two levels, and that's the 2 standard deviation. I'm not going to go into this model in great depth because it would take me another half an hour and I need to do a separate video on this. But what I'm seeing here from the options market is the market is expecting about an $18 move on the day. Actually, to be honest, that sort of differentiates itself from what we've been seeing in average true range. And you can see here that the expectations of movement have been increasing relative to where we've been. Let me go back and I'll answer some questions as we go in a minute. I can see a couple more, but you can see that the expected movement, $18, and if you times that by 2, that's where you get your range on the day because you're using that to buy volatility. Actually, at the highest level really since June. So while we've seen ranges falling, the expectation for movement has picked up a little bit. Now that plays into my stop loss because stop loss, where you're putting your stop loss is needs to be dynamic relative to the movement that you see in the market. So yeah, you really want to be looking to have a stop loss about 18% away. I think above this 50-day moving average and above these levels would probably be a level that I'd be looking at. That's sort of above $18. That's enough breathing room to say that the market sees with about a 68.2% level of confidence that you're not going to get stopped out in that position. So I think above there, if we are going to start seeing those dollar flows going through, if the real rate markets start kicking up, and again, what we can do is we can have a look on TradingView at the bond market here. Have a look at just 10-year generic 10-year treasuries. How much does that look like the US dollar? I mean, you know, if this is going up and it breaks through this 155 level, the US dollar is probably going to go through that 94.50 level as well. So I think that's a really interesting one there. So definitely keep your US 10s on the radar. We had a little bit of a pullback. We're back challenging this ceiling here. I will say this. If this breaks through here on a closing basis, 155, that US dollar is going to kick higher, and it's going to kick higher versus the funding currencies. So if you look, Yaz, I can see you've got a couple of questions around dollar yen. Dollar yen, if you're trading dollar yen, keep all these different parts of the curve on the radar. If this kicks up, then the dollar is going to strengthen, specifically against your funding currencies. So your euros, your Swisses, and dollar yen as well. Let's have a look at that dollar yen chart that you're interested in. Bit of indecision playing through. You've got that big doji there. You've got an inside bar playing through here. Again, this really needs. It hasn't had the same follow through that we saw from the Treasury market, where the Treasury market's pushed up to take here. The dollar yen hasn't really sort of caught that. I do think though, if we're having a look at the rates market. And you can see here the expected levels of rate hikes that are being priced into the market. You can see here the purple line is what's priced into the Fed funds future curve for December 2024, nearly about 80 basis points. You can see 75 for next year or for 2023. That's starting to move up. And you can see as this is moving higher, more interest rates are being priced into the US dollar curve. That's having an effect of sellers in the Treasury markets pushing yields higher, and that will have an effect, in my opinion, on what we're seeing in dollar yen, dollar Swiss. That's probably not seeing the sort of love that we would see, but we are seeing that in euro dollar. So the dollar strengthening against the euro, can that continue? Well, we have to see those 10-year Treasury yields and relative to what we're seeing in Europe. I think that's really absolutely the key situation there. Right, so we've got a potentially strengthening dollar. We've got potentially weakening sell-off coming in the Treasury market. We need to see, for that to take place, we need to see a good payrolls number. We need to see equity markets find their mojo back again. We were talking about the debt ceiling with clients recently. The debt ceiling debate looks like the Republicans are giving a bit of a short-term reprieve, but we are going to see that being revisited in December. Okay, so we were concerned that the Treasury was running out of borrowing from around the October the 18th. It looks like it's been pushed out to December. Now, that's a concern for me because we get a government shutdown coming at the same time again as the debt ceiling. So whilst this was a big problem a minute ago, now we're actually just pushing and kicking the can down into December. So we're going into a seasonally quiet time for markets in December. We are going to have to struggle with the government shutdown, which isn't really a market event, but the debt ceiling will need to be revisited again. What's going to happen if we do really look over the edge and say the US could technically default? It's probably going to be a very low probability, but we ask the question as we get closer to that time, what if? I think in that situation, that gold will be a fantastic place to be. But for now, other traders are looking at other markets that are moving very closely. I take a tactical view that the real rates and treasuries are selling off where yields are going higher. And if we can break 155 on that, the dollar is only going to go one way. And what does that mean for my view on gold? Well, it means that gold prices, in my opinion, are probably going to go lower and trade down into this level here, which is the bump where the options market is saying that we should trade we should be contained within these two levels with a 70% level of confidence. So we could probably come down into the 1731, providing all that situation kicks off. But I think, we'll probably be contained into these lows of 1721. But this is a fairly lifeless market. The question we've got to ask ourselves, is this the calm before the storm? And we like to play other volatile markets, or is this ready to explode? Of course, when you've got these sleepy conditions, there's good ways to play that at the moment. You're working with, small moves playing through, but that still means that you can make money in that situation. So for now, we just want to let price push us into a trade. And in my opinion, I think the risks are for a stronger US dollar, which probably means that the gold price is going to trade down into 1732. But if it starts to crack and we can take it into a shorter time frame, that's when I'd be going for the ride. So I'm just got this on watch list at the moment. If it starts to see sellers, if that 10-year treasury can push through 155, if real rates can become less negative and that dollar breaks through 94.50, then gold price is going down. I'm watching this pricing, I'm watching the triggers, and I'm going to prepare to trade that as well. So watch non-farm payrolls numbers tomorrow night. Continue to watch what's happening in volatility. Continue to watch what's happening in equity markets. If we do see higher equity markets, I think that could be bad for the gold price. I think it's going to take away the attraction of gold, and it will probably push real rates higher as well, which again will be negative for the gold price as well. So tough one at the moment. I favour the downside in the short term. I've got my conditions that I've talked about, and of course, let's see how this goes. So anyone who's trading non-farms, anyone who's trading the news around that, obviously, good luck to you all. We've got natural gas very much on the radar, as I talked about. If this cracks through these lows, I think there could be a raft of profit taking playing through. Remember, there's been so much trend following money put into this. CTAs are absolutely piled into natural gas, whether it's UK, European, or more specifically US. The CTA holdings are very strong. We've got this bearish side reversal, as we've seen in crude. If this continues to break lower, that could have big implications on markets. So my best guess at the moment is that with the dollar's going to strengthen, the equity markets probably do bobble around, make anyone's guess. But I think probably if you put a gun to my head, I think the gold price trades lower, but I want to see a stronger dollar. And I want to see 10s breaking 155, and then I'll trade it accordingly. So if you like the video, do hit the like button, hit the subscribe button. If you want to reach out to me on Twitter, Chris Weston @_Pepperstone. If you want me to sort of focus on anything else to do with gold or any other aspects that I think I've missed out, then do let me know. I'm trying to cover off volatility. I'm trying to cover off fundamentals, technicals, and try and give you a sense of the probabilities that we've got at trading at the moment. So for anyone out there, good luck trading, and I hope it all goes well. Thank you.